Can you make massive amounts of money with Disney? Welcome back to the channel. Today, we're diving deep into the Walt Disney Company. From theme parks and movies to streaming and sports, Disney is a name we all know and love. But is it a good investment? We're breaking down the numbers, growth drivers, and challenges to answer that question. Whether you're new to investing or a seasoned pro, stick around, you don't want to miss this. Let's start with a brief overview. Disney is a global entertainment powerhouse with assets ranging from theme parks and resorts to streaming platforms like Disney Plus and Hulu. In fiscal 2024, Disney posted $91.4 billion in revenue, cementing its place as a leader in the industry. But with competition heating up and the media landscape evolving, let's see if Disney can stay ahead of the game. Disney ended fiscal 2024 on a strong note, with Q4 revenue of $22.57 billion, up 6.3% year over year. Net income surged 74% to $460 million, and free cash flow hit $4.03 billion. For the full year, Disney generated $91.4 billion in revenue, supported by cost-cutting efforts that drove a 22.8% increase in operating income. Streaming was a standout performer, contributing $321 million in operating income for Q4. With 4.4 million new Disney Plus subscribers, the company now boasts 174 million subscribers across its streaming platforms. Disney has made impressive progress in improving its leverage. As of fiscal 2024, its S&P adjusted leverage stands at 2.2 times, comfortably below the 2.5 times threshold required for its recent credit upgrade by the S&P Global Ratings. This is a big deal because lower leverage indicates stronger financial health and reduces risks tied to debt. S&P expects this metric to improve further, with leverage forecasted to drop to 2.1 in fiscal 2025 and 2.0 by fiscal 2026. Even with potential one-time expenses, like completing its Hulu acquisition from Comcast, Disney is not expected to breach the 2.5 mark. This disciplined approach to debt management adds a layer of financial stability that should give investors confidence. As for capital expenditures and cash flow, Disney is planning a massive $60 billion investment over the next decade to expand its parks, resorts, and cruise lines globally. For fiscal 2025, CAPEX is expected to exceed $8 billion annually, up from $7.5 billion in 2024. While this heavy spending might seem risky, Disney's ability to generate robust free cash flow, projected to cover both these expenditures and shareholder returns, makes this manageable. Additionally, Disney has resumed shareholder payouts, with $4.8 billion in dividends and share buybacks planned for fiscal 2025. This balance between reinvestment and returning capital to shareholders highlights Disney's strategic focus on growth without sacrificing financial discipline. Disney ended fiscal 2024 with $6 billion in cash, down from $14.2 billion in 2023. This decline reflects the company's reinvestment strategy in high-growth areas like streaming and parks. Disney's total assets stand at $196.2 billion, with goodwill and intangible assets accounting for a significant portion. These assets underscore Disney's dominance in brand value and intellectual property, key drivers for its long-term growth. Their long-term debt has steadily declined from $51.8 billion in 2021 to $41.9 billion in 2024. By controlling its debt while increasing CAPEX, Disney ensures it remains financially flexible for future opportunities. As for their growth outlook, streaming remains Disney's most exciting growth area. In fiscal 2024, streaming ad revenue reached $3.7 billion, slightly outpacing linear TV revenues. This signals Disney's successful pivot to digital, a critical move as linear TV continues to decline by 9% annually. Disney Plus and Hulu added 4.4 million subscribers in Q4 of 2024, bringing their combined total to 174 million. S&P projects double-digit revenue growth in streaming over the next few years, thanks to Disney's unmatched IP and children-focused content, which competitors struggle to replicate. But profitability is a real story here. After years of investment, Disney's streaming business turned a $321 million profit in Q4, a milestone that suggests its digital strategy is on solid footing. By fiscal 2025, Disney expects $1 billion in streaming profits, further reinforcing its dominance in the direct-to-consumer space. Disney's parks and resorts remain a cornerstone of its business, contributing $8.2 billion in Q4 revenue. While attendance growth has plateaued, per guest spending is rising, driving steady revenue gains. The company's $60 billion CAPEX plan focuses on expanding park capacity, introducing new attractions, and growing its cruise line fleet. These investments are designed to attract more visitors globally and capitalize on high-margin experiences. For long-term investors, this represents a stable and growing revenue stream. As for their earnings growth projections, earnings estimates for Disney have been revised upwards, with EPS projected to grow 8.3% in fiscal 2025 and 13.1% in fiscal 2026. Analysts expect these gains to be driven by continued profitability in streaming, revenue growth in parks and experiences, and effective cost management in linear TV. Disney's commitment to reducing debt, maintaining financial flexibility, and reinvesting in its core businesses positions it well to achieve these targets. Despite its strengths, Disney faces some challenges. Linear TV operations continue to decline, with annual cash flow dropping in the mid-teens. Additionally, programming costs in the sports segment, particularly for ESPN, are rising. However, Disney's ability to manage costs and transition to a more streaming-focused model positions it as the best-equipped legacy media company to weather these challenges. The big question is whether Disney can execute on these strategies under Bob Iger's leadership as he prepares to leave in 2026. Disney's stock has gained $30 per share since mid-August, and its valuation also looks appealing. S&P Global Ratings rates it as a B in valuation, indicating the stock is trading at a discount to its peers. With the expected EPS growth of 8.3% for fiscal 2025 and 13.1% for 2026, the stock could have significant upside if Disney delivers on its growth targets. However, Disney has underperformed the S&P 500 over the past decade, gaining just 25.8% compared to the index's 191.5%. This highlights the importance of its current pivot to streaming and operational efficiency. Is Disney a buy, sell, or hold? Disney's brand power, iconic IP, and diverse business model set it apart. Its ability to monetize content across multiple platforms, from films to streaming to theme parks, gives it a competitive edge. For long-term investors, this makes Disney a long-term play. Whether it's its profitable streaming business, ambitious park expansion, or disciplined debt management, Disney is laying the groundwork for sustainable growth. However, risks in linear TV and rising CAPEX make this a hold for cautious investors, but a strong buy for those with a long-term horizon. If you believe in Disney's ability to execute, now might be the perfect time to add the stock to your portfolio. Do you think Disney's poised for a comeback, or should investors be cautious? Let me know your thoughts in the comments below. And if you enjoyed this breakdown, don't forget to hit that subscribe button for more easy-to-understand stock analyses. Together, let's make smarter investment decisions. And as always, happy investing.